Welcome everyone to the last webinar in our M&A advisory series. Today we're going to go over valuation. Before we get started, there's just a few housekeeping items I want to go over. Just so you know, you can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a questions box that you can use to type in your questions and click submit. And I also want to make sure everyone has great audio. So if you're using a telephone, make sure you're selecting the phone call audio option. If you're using your computer, make sure you select the computer audio option. And then as a reminder, we are on social media. We're on Facebook, Twitter, Instagram, and LinkedIn. So make sure you're following us. And now I'd like to introduce the presenters. Today we have Greg, who has experience valuing businesses in the enterprise software, information security, data science, life science, and entertainment industries. He also has experience servicing logistics, retail, food services, and food processing entities. We also have Dean, who after spending 12 years as an auditor here, he has transitioned to the chief relationship builder for the firm. He helps numerous private, public, and nonprofit companies address their tax, audit, and outsourcing accounting needs. And with that, I'll pass it off to Dean.
Great. And as you heard Marie say, this is our last webinar in the M&A series. You could see some of the titles that we have covered in the past couple months, and if any of those are maybe speaking to you as you look to plan your potential M&A deal, feel free to go to our website. They're all recorded there, and you can access some of those topics very easily. State of the market, you can see that we've had a strong run up of deals, and then that's not really stopping. It will be interesting to see what happens in Q2, right? I mean Q4, Greg. We have definitely seen some variability with regards to interest rates in the stock market.
Yeah, I definitely think that Q4 will be interesting. We often see people try to rush to get things done as year end. Also, as you say, with interest rates changing, that might impact some transactions, but also with the volatility of the stock market, people might be out there looking for some bargains.
Right. We have definitely seen that in our client base already. So it will definitely be interesting to see what happens. The thing here, you can see state of the market and that deal size is definitely increasing. Valuations are high, no doubt about it. Everybody's feeling good right now, and if they're going to sell their business, they're going to want a nice little premium. Is that fair to say?
No doubt about it. Actually, your chart there is very interesting because obviously you start in 2009 when the market was at
all-time low,
at a trough, right? If we went back a couple of years earlier when we had some of the exuberance of the .com, we might see some trends where it was a little bit higher.
Oh, here you go. Look at that. Spoken like a true valuation expert.
But certainly values have been up lately, and I think the market, if you go through, as you have before through September, the market values were high. We've had a lot of volatility and some decline over the last 2 months. We'll get back the last couple of days, but certainly valuations have been high this year.
Yep, and that is definitely a sense that we're seeing out in the market. We can see deal value is probably going to finish close to where it was over the past couple years. Things are trending in that direction. We'll see what happens when we'll do a recast webinar in Q1 of 19 to kind of wrap all this up and see what it looks like. But yeah, proportion of deals above $100 million continues to swell. It's there, and that's kind of where this webinar series was born from, is to try to add some value to everyone in our network on what that looks like. So with that said, we'll kind of get started here. Our agenda today with Greg is to try to talk about valuation and ways to assess that value, different methodologies, different ways to look at buyouts. We'll talk about cash flows and purchase price. So with that said, let's get going with the start of the show.
Well, I like to think you saved the best for last, but I'm sure that's just a matter of opinion. But thank you, everybody, for being here today. Certainly, we're going to talk about value. We're going to talk about getting your company ready to go. And we'll talk about it from a couple different perspectives. Certainly, we have private business owners that operate businesses in a certain fashion. And then we may have some people out there that are venture capital or VC backed, and they operate their companies a little bit different. So when we think about value, or we think about getting your company ready for sale, it might be a little bit different for those two types of owners. So we'll try to address both of those today.
Great.
I mean, certainly if you look at this, the old, buy low and sell high. I mean, it sounds like a cliche, and it is, but certainly it makes a lot of sense. I mean, when you're trying to sell a company, obviously you want to get the highest price possible, and certainly if you're looking for acquisitions, you want to buy as low as possible so you can maximize the benefits. So that's going to be the struggle that we'll try to help you bridge. And I used to joke that when we do valuations for both sides, if we make both sides angry, the buyer and the seller, we've probably gotten a pretty good answer.
That's actually a good, makes sense though.
All right. So we can go over as selling to get ready to be acquired. I mean, there's a lot of things that companies do. We'll start with the family and the closely held businesses. A lot of times our clients, they try to minimize taxes. So what I mean by that is often a lot of times you'll see these companies that could potentially be very profitable are really at a break-even sort of profitability. And when you look at value, what the buyers are
break-even profitability by design is what you're saying.
By design, absolutely. And that's what we talk about, minimizing taxes, not doing anything illegal, but they'd rather keep the money for themselves or reinvest it in the business than pay the government. So when we see that, what we really talk to the clients about is trying to do pro formas and normalizing the profit and loss statements to show a potential buyer, what would the profits be if you tried to maximize profit? Because in valuation, you're going to be valued based on future performance expectations, and really that would be in the form of potentially cash flows, revenue, and growth. So sometimes these family businesses have been around for a long, long time, and the growth is fairly well known unless they're going to do something different. So unlike maybe the venture capital type companies where growth probably is a
primary driver
and much newer companies, so growth can be much more substantial. That's not always the case, but I would say that that's often the case. But on the family held or closely held companies, what I would say is, look at what you can do. Are you running extra expenses through there? Do you have extra family members maybe on the payroll that you might not need? Do you pay yourself above market salaries to minimize taxes? All those type of adjustments we try to look at. Sometimes companies own their own buildings and they do it separately, and so maybe that's not fair market rent or things like that. Again, just things they do to minimize taxes. So those are all the levers you should understand before you get into a sale process, so you can make those adjustments to make your company look as attractive as possible.
Right, and also, or maybe even just to another buyer, the benefit of owning the company is all of those benefits as well. Maybe they don't want to maximize profit, but they want those types of same benefits.
Absolutely. So what I think about is more companies are bought based on potential than what they've actually done in the past. Obviously, for family or closely held businesses, they often have much longer histories, so that looking at the potential, people will look at the past results to hopefully correlate that potential. For more of the venture cap companies, VC-backed companies, definitely look at growth, and then ultimately that growth will at some point in time correlate to profitability or cash flows. But they're looking at market share, they're looking at anything that could show leadership in your particular industry, because often you're looking at what you can do and where you are, because you're usually in a much earlier stage type company.
Right, and that's the synergies that you're talking about there, the things that someone can add and get some leverage off of.
Absolutely. And then there's a few different types of synergies or things at the bottom as we talk about sale of your products to their customers. So even though you might have some cash flows, you might be able to get some benefits there, or their products to your customers. Those are certain sales synergies that we often see. Other type of synergies we see, or other things that you might want to highlight, is any cost savings. Maybe putting two companies together, you'll get some buying savings or some economies of scale that you wouldn't get as a solo company. And then also the typical thing we see is overlap in certain responsibilities. So you might be able to generate more revenue with less people when you put the two companies together.
Sure, and that routinely goes to what? Finance and IT and some of those types of things?
Yeah, finance and IT primarily. Usually it's admin and those sorts of things. I think the key thing is to know your company, know what your levers are, what you can push or not push, and then those are the type of things that you want to highlight to the potential sellers.
Sounds good. Sounds good, Greg. All right, so we basically have 3 valuation methodologies. Why don't we walk through this real quick?
Absolutely. So an income approach, most people would be synonymous with a discounted cash flow approach. There are other types of income approach, but that is the most common one. And that is really based on the value based on your forward-looking revenue cash flows for the business. So very forward-looking. A market approach is based on typical multiples. So most people look at it as price to revenue multiples, price to earning multiples, sometimes EBIT, earnings before interest and tax, or EBITDA, earnings before interest, tax, depreciation, and amortization. And you can get those multiples from a couple of different sources. Certainly publicly traded companies, you can go out there and find them. Everybody always says, so my company's not as similar to anybody else, but it is a comparison, and you can think about it as an investment alternative. The other thing is there are some databases that show M&A transactions for similar type of multiples. So you can do it based on the public marketplace or actual M&A transactions. Lastly is the cost approach. Not typically used for operating companies. It really says what is the cost to recreate the company. And what it does is it really doesn't take into consideration all the benefits, the goodwill, the other intangible assets that you have created. So we typically see that in very limited circumstances, but not typically in circumstances of sale of transactions.
Great. Okay. Let's talk about some shareholder buyouts.
Sure. So certainly, valuation has a lot, in transactions. Certainly you have to do valuations beforehand to say, what is my company worth? But certainly in the buyouts, depending upon this purpose, there's also valuations after the fact, which is the valuation of, or setting up your opening balance sheet for either tax or accounting purposes. So we certainly do the valuations beforehand, give up companies an idea of what their company's worth. We can do sensitivity analysis. If you assume this cost of goods sold or this amount of synergies, what would those benefits be? But then we also do the valuations after the fact, and it's a big part of what we do is setting up the opening balance sheets. In that case, it's a much different analysis. Is what are the value of the assets that you've acquired, and those assets can be a variety of things. It could be technology, it could be customer relationships, it can be beneficial contracts, it can be trade names, covenants not to compete, a whole slew of assets that need to be valued either for tax or accounting purposes.
Okay, sounds good. Let's talk about cash flows now. This is kind of what it's all about, I guess, at the end of the day, huh?
It really is.
This is where the rubber hits the road.
Yeah. The whole theory on the discounted cash flow analysis is what are the cash flows that I would expect to receive? And that's really what I'm willing to pay for the company. And it really reflects the benefits that you're going to get. I mean, this is certainly candidly much easier to do for more established companies that have history of cash flows as opposed to earlier stage companies that are new in their markets and are building their cash flows and may not even be cash flow positive currently. But
they have sales.
They have sales.
And that's kind of what people are buying in that instance.
Well, they buy for sales with the theory that eventually that sales will become cash flow. And one of the things that what we see in projections all the time is we see companies spending a lot of money for growth, but they never show always when you get to the end or profitability. And it's like, well, if you're going to spend all this money at some point in time, it may not be 2 years, may not be 3 years, but at some point in time, you'd want to see the benefits of that investment. Yeah. And that's really where the cash flow comes in. And it really is a good way of valuing companies, even earlier stage companies, because you can take the cash flows out a long time. I mean, we all know the cash flows are going to be wrong, but hopefully they're going to be reasonable. And you look at growth and you look at things as they progress. I mean, a company that's going from 1 million to 2 million, that's 100% growth, obviously.
Yeah.
And that's very realistic. Going from 200 to 400 million the next year is also 100% growth, but much more hard to do. So, again, when you look at the cash flows, you're trying to look for trends. And again, can you maximize? Is investing in sales today to have negative cash flow today for positive cash flow in 3 or 4 years that's much higher than you would do otherwise? That's usually very beneficial, and that's value creating. You look at corporate buyers versus company buyers, and sometimes with corporate buyers, they're looking at not only the cash flow, but how can they perhaps even leverage the company to pay for it, where corporate buyers are also they might look at that, but they might look at it how it fits in a little bit more strategically, along those lines. And I know it's up here on the slide, but, I think it's really important to know who your potential buyers are, because if you do that, you can kind of frame your company in a way that will make sense to them. As you see, the private equity companies, they come in, they buy the company, and it's an investment to them. And they create and they raise funds, and at some point in time, they need to exit their funds and make returns on their money. So they're looking to buy a company, provide their expertise, maybe turnaround situation, maybe show where they
find some operating efficiencies, maybe, right?
Absolutely.
Clean them up. I mean, that's kind of what we mean by that, clean them up, is they're trying to find areas of pockets of profitability, right? That they can input into the business.
Absolutely. Because their goal is to ultimately sell the company again.
Yeah, they want to monetize.
And in some, relatively short period of time, 3 to 5, 3 to 7 years, because most of these funds have 10-year lives. So they have to then do that. Corporate buyers, they may not be willing to exit. I mean, they may be thinking of exiting as a whole for the corporation, but they're really trying to build something bigger, and they tend to have much more of a longer term focus.
Right. So there, you could see there that just the focus of the ultimate buyer of your business, they're going to want to hear a different story, or they're going to need to hear about those opportunities versus, hey, my customers, I have customers that would meld well into your business, and you could sell to my customers, and vice versa.
Absolutely. So you think of the corporate buyers are going to be much more synergy oriented in terms of putting the two companies together, where financial buyers will be much more in operational orientation and growth, so that they can maximize benefits, because they'll add some expertise, but they're not going to have the corporate synergies that a corporate buyer would have.
Great. Well, then let's talk about it.
Right.
So now we're to the purchase price.
All right. So depending upon where we are, assuming you get an offer, really understand how that offer came about. I mean, what is it based on? Is it based on really achieving certain growth targets? Is it based on achieving certain earnings targets? Is it based on your historical results? Or is it based on your prospective results? So that's really what I mean by understanding how the value is established, understanding what those key points are. And then for you as the seller, you want to look at what happens if I change growth. If growth is 10% instead of 5% over some period of time, does that mean my value is double, or is it something different? And those are things. Or if I get this amount of cost savings, what does that mean to my cash flow? And if it's a multiple of cash flow. Or sometimes we see companies saying, hey, this is my core business. I've got some new opportunities, and make sure that those maybe are reflected in the value. So those are all things that it's important. So understanding who the buyer is, understanding the inflection points of your company value and what you can offer, because not only are you selling a company, you're really selling you as part of it. Certainly, as we talk about technology or the products, is really understand maybe the motivation of the acquisition. Are they buying people? Are they buying technology? Are they buying time to market, first entrance, and they're buying speed? There's a lot of things that people are buying. It might be all of those things, but certainly understand what is being bought, or what it is the motivation is, because if you can do that, again, you can position yourselves better, and the more information you have, the more understanding you have of that, I think you'll do better achieving the highest possible valuation for it. So we talk about diluting earnings per share. That's really for public companies. What I find is public companies, when they make acquisitions, in the short term, they may be willing to accept diluting EPS, earnings per share, but really that tends to be a very major focus of theirs, is to avoid diluting earnings per share, because that's how they're being valued in the marketplace. And to be honest, that's how their management is probably being evaluated themselves. So they want to do everything that they can to avoid anything that makes their company look bad. And that's also important, actually, if you're being acquired by a publicly traded company, understand how they're being valued. Is it price per revenue, price per EBIT?
Right.
Because
are they a profitable company yet, or are they not?
Exactly. And if they're being valued at, let's just say, 10 times earnings, and they offer you 8 times earnings, when they put it together, all of a sudden they're going to get that little bump in value because they're going to be valued more than what they're paying for you. But you might be able to use that as a negotiation as to get a little bit better value as well.
Right. It just kind of reminds me of of when Amazon acquired Whole Foods. Right. You look at the theory behind it. It was something that they could, they already had an established marketplace. They had all those facilities. They had dreams of, we're going to distribute. And now here we are sometime later, and you see it. You go to Whole Foods. It's a little bit different now, right? It's different.
No, it is different. And then you have Amazon has their I don't know what they call them, their autonomous stores, or
right.
You go in there.
Yeah.
So sometimes the acquirer isn't always obvious of who it might be. I don't think anybody would have thought Amazon would be acquiring Whole Foods, but
retail stores, right? The king of online buying retail stores.
Exactly.
Yeah, and then everybody said the purchase price, but then their stock price went up by the amount of the purchase price the following week. So it was almost like they got that company for free.
But yeah, no, that's definitely important to understand all that. And then sometimes, you just may have disagreements on value.
Let's talk about that.
Right. And obviously, beauty's in the eye of the beholder. Many companies, you're very close to your company. And so sometimes owners have inflated opinions of value just because they're very close to their company. They've built it. It's almost like their baby. Sometimes they're very realistic. But there are situations where the buyers and the sellers want a deal to occur, but they have fundamental differences, or they want to motivate the sellers to achieve what they say they're going to achieve after the closing. So they put in these earnouts. So earnouts is you have usually a base transaction, then you'll have an earnout either based on revenue, based on earnings, based on 1 year, 2 year, 3 years. I've seen it in all different. But really what that is a way to bridge differences in values. You say, hey, if I'm this confident that I'm going to do this, I'm willing to take an earnout because I'll achieve it, and I'm going to work hard to help achieve it. And that may suit everybody's goals together. Obviously, the way you word the earnout, the way you're able to monitor the earnout, that's beyond my skill, but it's important to do that because you want to make sure that both the buyers and sellers are aligned so that if you do achieve what you're trying to achieve, that you actually get that earnout payment.
Okay. No, that sounds correct. What should be people, what can we, if people are looking at, 2019 is going to be the year that their acquisition happens. What can they be doing to be, forward looking and strategic?
Absolutely. Start now is what I would say. So certainly there are a number of things you can do, but really I would say know your financials, because that's going to be the first thing that people are going to look at. I think, what can you do to achieve or increase profitability or growth? And certainly, depending upon how you've stated your financials historically, certainly do pro formas to get you to that, to show how your company would look if you were trying to maximize profit, if that's not currently your goal. Doesn't mean that you have to do it. So again, for the private company,
but you should
owners,
know what that looks like.
Know what it looks like.
Right.
And make sure you understand it. In fact, we just went through a transaction very recently, I should say, where we made through the adjustments. We came up with a value, and the potential buyer came back and really went through it. And actually, the adjustments they came up with were very, very similar to what we did. But that's what you need to do, because that's what people were looking at. So,
Greg, quick question on that one though. Yeah. So say you're, a closely held business, and you want to be prepared, but sometimes they don't tell the finance and accounting team that that's what the ultimate closely held owners are looking at. Do they work with the CFO here? How does that normally work out?
Yeah, you can do it either way, but usually they'll hire someone like Armanino or a firm that can go in and work with them and do things on a confidential basis. Because as you correctly state, sometimes you don't want to advertise that you're trying to sell the company to your people,
Right.
or even to the marketplace, depending upon the situation. So you're working with people that have good understanding of financials, your accountant, your tax preparer, depending, can help you do it because they'll know the financials and the expenses and what you're doing that might be ways which you're doing to minimize taxes. So
Got it.
definitely do that. So know your financials, number one. I'd say know the buyer too, or who the buyers are and what their motivations are, because you might make your pitch a little differently if one's a corporate buyer versus a financial buyer, or if one's a buyer trying to roll up a number of companies together, or if one is trying to get into a region and maybe you're contiguous to them or something of that nature. So understanding who the buyer is also is important. And then figure out what you want. That's always really a very important thing is, do you want to keep working? Do you want out of the company completely? So again, when you're structuring the deal, you can do it in a way that hopefully maximizes what your goals are as well. And then certainly, if you want the money up front, do you want it over time, depending upon how your cash flows and everything are? So those are all things that you really need to look at and understand. So just in summary, know your financials, try to know the buyer, and try to know what you want to get out of the transaction.
And Greg, that sounds really good if you're looking to, maybe monetize your company next year or in the short future. But what if what if there's an opportunity? What if we have some clients out there that are thinking, I want to be an opportunistic buyer, acquirer of other businesses? What could they be thinking about right now going into 2019?
Yeah, I mean, it's somewhat similar. Is think about what it is you're trying to achieve by doing that. Are you trying to achieve, again, going into a new region? You're trying to get into a new product or something like that. So
New client base or something like that.
absolutely. So think about what you want to do and then target those areas of what will give you the maximum benefit. Because everybody's goals of acquisitions or what they want out of it might be a little bit different.
Okay. Sounds good. Let's see. Do we have any? We've covered a lot. Do we have any questions? It doesn't look like we have any questions. We will pause momentarily to see if any questions come in. And if you think of your question, maybe after we sign off, feel free to email Greg and I directly. As we said, we will be putting everything up on our website, and we will. It's all there for your view, and feel free to reach out to us. I know it's always an exciting time when you're trying to monetize, your life's work.
It is, and just in personal experience, I had a similar situation. So I had a firm, and I have sold one. So I've gone through this, and I've understood kind of some of those things. So I can preach, practice what I preach, and. No, we're not getting any questions. That means one of two things, Dean. Either we answered all their questions, which I would hope to be the case, or we confused the heck out of everybody.
Either one. Reach out. Feel free to reach out. We're here to help you guys. It's been a great M&A webinar series, and we look to touch base with everybody more in 2019.
All right. Thank you, everybody.